Welcome back to the After the License channel. If you're new here, I'm Jeff Bittner. This is the channel where we help real estate agents build their real estate business. And I also run a team in the Phoenix area. Last week, I did kind of a market update. Are we going into a recession? Update on the housing market and if we should be kind of headed for the hills as real estate professionals. And got a ton of great feedback on that video. And since then, we've got some new data that started to pop up. So I wanted to do another kind of update video on that. So we're going to talk about mortgage applications. We're going to talk about mortgage rates again. We're going to talk about mortgage applications for new home builds and some data we're seeing around that. And then I'm going to showcase an article that I think does a great job, again, kind of summing all of this up for us real estate agents and professionals, and also talks about some tips for you, the real estate agent, as you navigate your own market. So let me share my screen here. There we go. And so the Mortgage Bankers Association releases data on mortgage applications. And so again, if you watch last week's video, I kind of talked about as mortgage rates increase, we're going to start to see that affect demand. And the Mortgage Banker Association releases some of those numbers in terms of mortgage applications, right? So if demand is going to decrease, we're probably going to see a decrease in mortgage applications. And as the data starts to get released, we are seeing just that. So this news press release was released last week on May 18th, and mortgage applications decreased 11% from the week before. And a new one of these articles just came out today and said that mortgage applications decreased another like 1.5% to 2% since last week. So we are starting to see that those higher interest rates are affecting kind of that demand aspect of it. And we see here in the article, it says mortgage applications decreased for the first time in 3 weeks. Now, again, remember this was last week, as mortgage rates, despite declining last week, remained over 2 percentage points higher than a year ago, and close to the highest levels since 2009. For borrowers looking to refinance, the current level of rates continues to be a significant disincentive. And so I wanted to pull up and actually just look at the rates, because when you look at a chart of the rates, I think this is kind of even more dramatic and drastic. So I've gone over here to the Freddie Mac website, and you can see here what rates have looked like over the last essentially year or so. Last year, we were sitting at that 3%. We dipped down into the 2s, come back in to low 3%. And then as we started to approach the start of 2022, we started to see this increase here, right? So we started to come high 3s, 4s, and now we're sitting here in the 5%. And again, just to kind of reiterate what this actually does for our clients and their buying power, it's pretty dramatic, right? So if I jump over here to the mortgage interest rate calculator, now I've got the taxes and fees section kind of turned off because I just want to showcase what this looks like. If you were to come in here and you wanted to buy a $500,000 house and you could get a mortgage in the 3% range, you can see here that Google is going to estimate your payment at around $2,100. Again, not including taxes and fees and all that fun stuff, but just talking about a loan and interest rate. Well, if you wanted to stay around that $2,100 a month payment, and interest rates have now gone from 3% to 5%, how much less would you be able to afford, right? And again, if you come in here and you start to play with the numbers, $450,000 doesn't get you into your budget. It's closer to $400,000. So that 2% interest rate bump, if you were looking in the $500,000 range, might have actually bumped your purchasing power down almost $100,000. And so again, this is what's affecting that supply and demand. The less someone can purchase, the less they're going to be able to purchase, the less that demand is going to be in that particular area. And so we're going to have to kind of keep an eye on what this does to our individual markets, because this is going to skew the supply and demand. And as I mentioned in this article here, and what it showcases is we are starting to see that there are less mortgage applications than previously, than a year ago, than even just a couple weeks ago, because people are starting to grapple with the fact that those interest rates are higher than ever before. Now, let's touch on something we didn't touch in that last video, and that is New home purchases. New home purchases, again, data released from the same Mortgage Bankers Association, new home purchases have decreased, and they decreased 10.6% in April. And let's look at this here. New home purchase activity declined on a monthly and annual basis in April as the spike in mortgage rates cooled demand and home builders continue to grapple with rising costs, supply chain issues, and extended completion times. With the supply of existing homes on the market still at extremely low levels, the new home market is an important source of housing supply. However, the pace of construction has slowed in recent months. MBA's estimate of new home sales declined for the fifth consecutive month to 701,000 units, the slowest sales pace since May 2020. So again, mortgage rates are starting to affect people who are wanting to purchase new homes as well. Now, this is an interesting kind of flip of the coin. If you paid attention in 2020 and maybe even in 2021, you probably saw articles on how new home builders were actually canceling contracts on people purchasing their homes, right? And that makes some sense. If you put a contract on a new build for $400,000 and prices appreciated to $450,000 or $500,000, it made dollar sense for those builders to go and cancel those contracts and maybe even pay a $20,000 fee, $35,000 fee to cancel that contract if they can go and flip that same house for $450,000, $480,000, $500,000. Well, now as interest rates rise, we're in this weird predicament where someone could have gone under contract on a house that was going to be, again, $400,000. They thought their mortgage rate was going to be 3% or 3.5%. Maybe they thought it was going to go up a little bit. And now it's in the fives. They might not actually be able to afford that house anymore. And so we're starting to see, I think, some buyers actually cancel their contract with builders just because it's not feasible for them to purchase anymore. So this is also going to have to be something that we keep an eye on because this is going to affect the supply and demand in our market as well. This might actually, again, add some supply that we hadn't seen in the past if these start to hit the market again. Maybe they're partially completed or maybe they're done and people just need to find, the builders need to find new buyers for them. But we are starting to see a decline in the mortgage applications for these things, again, partially because, in my opinion, it's those interest rates. So back to what do we as real estate professionals do with all of this info? A lot of this can feel scary and it can feel doom and gloom and it can feel like we're headed for the end. And I'll stress what I've done in weeks past in the last video, which is we all are just going to have to take a step back and see where this takes us. Because we've been in such a skewed market in the past, and up until this point, this might have more of a flattening effect than a sharp decline. Now, I want to point to an article, and this is from Inman. I'm a big fan of Inman. I've done other videos on some of these Inman articles, and so would highly recommend that you go and spend the $15 or $20 to get a subscription because they've got a ton of great info on here. But this article in particular talks about why, yes, there's a lot of negative news, but the overall outcome might be more positive than we think or than we feel in the moment. And so it says, stop Googling bubble. Here's why the news may be more positive than you think. So I'll put a link to this and all the other articles in the description of the YouTube video. So go check these out. I'm not going to read through this entire article, but I did highlight a couple points that I think are important, right? So it says 2 reasons why crashes occur. Again, if we're scared, if we're worried, like, is this going to be the end of this fantastic market that we've been in? Or are we going to end up in a really bad housing crisis? There are really 2 reasons crashes occur. It says crashes occur either because credit is loose, and we saw that in the last housing recession, or the economy stinks. Today, it is much harder to get a mortgage than it was in 2000, which was a fairly normal year. Also, we have an employment deficit of about 2 million to 3 million unfilled jobs. So basically, there are more jobs than there are people to fill them, which is typically the sign of a good economy. It says, furthermore, demand is still dramatically outpacing supply. And again, we talked about this. Demand has been so high and supply has been so limited that if we start to see a leveling out, it might not actually be a bad thing. And then the article goes on to actually talk about that supply. It says the high level of demand is also being fueled by people who own properties and feel they have nowhere to go. So that is still going to hamper supply a little bit, and they go to touch on that. Because supply deficits are self-fulfilling, they are self-reinforcing. So many owners are sitting in their houses saying, I'd like to move, but I can't possibly afford to move. With interest rates at 5.5%, housing prices have just run away from me, so I'm going to stay here. Those units are not going to come to the market. So again, we're going to have to kind of figure this out as we go. Supply might be increasing in some areas, but it might be hampered in other areas. Demand might be coming down slightly. But at the end of the day, as real estate professionals, the thing I'll continue to beat the drum of is there will always be houses sold each and every day. No matter the market, we are just going to have to learn and adapt and grow. And so the last part that I'll touch on this article, because I thought it was really fantastic, it says, great advice for industry professionals. There is no national housing market. So in some of these videos, I've touched on kind of the national averages and the stats, but they say there's no national housing market. There are hundreds of thousands of housing markets. It's incumbent upon real estate practitioners to know the facts about their market, employment, who's employing, who's coming in, who's going out. They must track the demographics and track the employment to know what's really going on. So that just goes back to you have to understand your market. You have to understand and put boots on the ground to understand what is the supply and demand like in your neighborhood or the city that you want to focus on? What is your city or town experiencing in terms of jobs and growth or a potential decline? It's going to be our job as real estate professionals to know and understand those things so that we can be knowledgeable. And again, we can make decisions in our business, but that we can also help advise people who potentially have questions on the housing market, buying, selling in a crazy market like this. So guys, I hope this was helpful. As always, drop a comment below if you have any questions on this. And if you enjoyed this type of video, let me know, and I'll catch you on the next one.